Is your housing market going to be crashing? With the economy likely headed towards a recession, which of the housing markets are most exposed and most at risk of crashing? As you all have seen, the last couple of days have been pretty crazy for the stock market. Stocks are down all over the place. People's 401ks are down. Everything is down. The one thing that hasn't quite dropped yet is housing. But there are definitely some housing markets that are probably more at risk than others. So in this video, we're going to take a look at those. We're going to cover which markets these are, how much these markets stand to lose, and what that would look like in the case of them resetting to equilibrium, aka the huge housing market crash that everybody's ranting about. So stick around to see if you live in one of these markets and what you should do about it. And don't forget to smash the like button and subscribe to my channel below so you don't miss any more great finance or real estate content. All right, let's get into it. So we're going to look at some data here from Fortune. This article is titled Housing Bubble 2.0, Regional Housing Markets Are Beginning to Look Like They Did in 2007. When the US housing bubble burst more than a decade ago, it brought the global economy to its knees. It turned out that the multi-year housing boom through the early 2000s was hiding skeletons. Homebuyers, driven by fear of missing out on home price gains, were stretching themselves well beyond their financial means, and zealous lenders were giving out mortgages, or better put, subprime mortgages, to folks who historically wouldn't have qualified. So that's some pretty good context on what was happening in 2007. So the market was actually pretty different in 2008 versus what it's looking like now. In 2008, people were getting mortgages that really couldn't qualify for them, whereas today it's a lot different. The lenders have been a lot more strict. And then the article continues. Fast forward today, where the US housing market is once again going through a historic housing boom. Over the past 2 years, US home prices are up 34.4%, including a 19.8 jump over the past 12 months. That 12-month hike is more than 4 times greater than the historic annual average posted since 1987. Our ongoing housing boom has more economists pondering the most feared word in real estate, bubble. So bubble is a really interesting word, and I think a lot of people have different interpretations of what that actually means, but this article does a good job explaining what they mean here. And it's right here. At the very least, many markets are priced exorbitantly compared to what local income levels can support. So that's really what a bubble is, at least a housing bubble. Can the income support the prices of the houses? So let's take a look at the data. So here we see the degree to which regional home prices are overvalued or undervalued for March 2022. And the darker blue it gets, the more overvalued, and the lighter colored means it's undervalued. You can see there's a lot of dark blue around here. There's a lot of markets that are overvalued. And in fact, I don't think there's any on here that are undervalued. So some of the worst offenders here are places like Idaho, which I think is the worst. So 75% overvalued. You have Utah, we have Phoenix, Nevada, Texas, Florida. So these are all the areas that are really overvalued. You can see here along the East Coast, everything is pretty stable. Not really a whole lot of overvaluing going there. And then similarly in California, which looks actually quite a bit different from what it looked like in 2008. And we're going to get to that here in a minute. Okay, so as the article says here, the most overpriced markets are Boise by 75%, Austin at 66%, Ogden, Utah at 63%, Las Vegas at 60%, and Atlanta also at 60%. And what's interesting is what's driving this is mostly migration. It's new people moving to the areas, especially as they're coming from higher cost of living areas, and they're coming with a lot of extra cash flow or income that these new markets aren't used to supporting. So when you have an influx of new people, the supply in the market just can't keep up. And so that's why we're seeing prices rise so quickly in these areas. And these two sentences here are great. Those places have all seen an influx of new residents amid the pandemic's work from anywhere boom. That in part explains why home prices there have soared well above what local incomes can afford. So now let's look at how this has changed from 2020. So right before the pandemic, you can see most of the markets here are priced where you would expect them, anywhere from 0 to 15%. Idaho was already starting to creep up a little bit, so was Spokane a little bit, and some parts of Michigan. But the rest of the market was priced appropriately or even slightly below. Now here's where it gets really interesting. As we look at this chart from March of 2007, you can see how the dynamics of the housing market have shifted from that time period to now. So we can see most of the overvalued markets were here on the West Coast. So California, Arizona, Washington, Oregon, and then along the East Coast as well. So New York, Virginia, Delaware, all of these areas, including Florida. And in between, you didn't have a whole lot of overvalued markets, which is really interesting. And you look at this chart here as well, a look at how these overvalued housing markets have changed over time. So you can see Austin, Boise, Vegas, Phoenix. You can see just massive spikes here, especially for Vegas and Phoenix. And then there are subsequent crashes during the fallout of the recession. And then now you can see them all starting to skyrocket again. So, it really begs the question, what's going to happen to those markets again? So we walked through the data that showed how much these markets were overvalued. Now let's take a look at some data that shows how much these actually fell during 2007. So this is some data from cnnmoney.com, and this is showing the markets that had the greatest declines in late 2008. So you can see here, I've sorted it here by largest declines, and you see a whole lot of Florida, California, Arizona, Florida, California. All of these markets, like I said, the ones on the coast were the ones that were worst hit. I mean, Cape Coral, Fort Myers lost more than 50% of its value. And all these others, again, are really significant declines. And again, the total decline for the housing market was only about 19% on average in 2008. But you can see for certain markets, they were hit way harder than that 19% average. Then scrolling down to the bottom, you can see some of the markets that weren't really hit as hard. So you can see there's some Texas, Illinois, Texas, Mississippi, Kansas, Louisiana. Those were the markets that weren't really hit too hard in 2008. All right, so now the natural question is, if you live in one of these markets, what should you do? Well, there's really two options, right? Either you sell or you stay. Honestly, this is a really situational dependent decision and something that's really hard to answer when painting a broad stroke. But I think really what's happening is as these markets are seeing massive increases in prices, those are probably going to be the markets that are going to be hit hardest in the downturn. But that doesn't mean that I think you should sell your home. Because if you do sell your home, what are your options, right? You're either going to rent or you're going to have to find another home in a similarly overpriced market. So I think if you're able to comfortably afford your home payment and you're not having any issues there, then you can weather a downturn, right? Even if the market declines 20 or 30%, if you're comfortably affording that payment, you're not going to be at risk of foreclosure or having any issues. And in all likelihood, even if we do see massive declines, in just a couple of years, that will recover and you'll have positive equity again in your home. Now, if you're an investor in one of these markets, I think my advice might be a little bit different because you can use what's called a 1031 exchange to sell your properties and roll that over into any other investment properties that you'd like to without paying tax. But that also means that you have to have another area lined up, you have to have another property lined up to buy, which again in this market might be pretty challenging to do given where interest rates are at and that home prices haven't really started to fall yet. So if you're an investor, honestly, as long as you're cash flowing, unless you're really, really concerned about the market just plummeting 50 or 60%, maybe like a Phoenix in 2008, if you're worried about a situation like that, maybe you want to consider selling some of your properties. But if you're not as concerned about that and you're comfortably cash flowing, then this is probably a situation I would say just weather the storm and ride it out. All right, guys, I really hope you liked the video. Please don't forget to smash the like button and subscribe to my channel so you don't miss any more future content from me. And I will see you guys in the next video.